All right, ladies and gentlemen, welcome to the FOMC special live session here on YouTube. And today we will trade Nasdaq, S&P, Dow Jones. We will trade everything and we will take home some money today. We have like 4 minutes until the Fed rate decision came up, and we will decide where should we take our position. So we have couple of targets here. On the downside we have this, and on the upside we have this. So let's see. I think that there will be some manipulation, so there will be like two stages. First it will go down, it will like a fake move, then it will go up, or vice versa. So what you guys think? Please do let me know in the chat if you think that it will go up or go down, so we can discuss together. Alright, it's the CNBC thing. Now everyone is locked up and waiting for the Fed rate decision here. I think it will be unchanged, but we will see in a very soon. I will be trading with my live funded account and also with my challenge account where I get from the Apex. So if you want, you can pass with 1 day with 80% off, linking down here. Zoro, well, thank you very much. Also, you are welcome to live session. We are locked up and ready for the Fed rate decision here. Ladies and gentlemen, get ready to make some money. 2 minutes left. So we're watching the chart in 1 minute. Let's see. We have a couple of bullish fair value gaps here. Market literally has been stuck in this range. We done a live session here. We solved these two positions and we finished here, and we are back in live here. Ladies and gentlemen, let's see, the market is now, I think, yeah, all flat. It is all flat now. We have 3 fair value gaps on the bullish side. So the 1 minute 50 seconds left. Yeah, FOMC meet. This is a Fed rate decision, and half an hour later J Powell will come and take in questions. The whole market is waiting for the rate decision now. I'm kinda ready now. Wow. The market is taking out these highs now. Wow. The trap is here, guys. I will not touch this crazy thing for now. We're taking out this high, the target here. It is unchanged, yeah, I think. It is unchanged and it's going crazy high now. All right. Still no position. Still no position. We are up 0.5% here on the NQ. The Fed unchanged. The rates here still sky up. Look at the spike. It's 150 points. We have big gap here. All right, some pullback here.
Order filled. Order filled.
$255. Quick scalp here on 13 ticks. I think we will take it out. Yeah, Zoro, buy position target was just here. We filled it. We could kept it longer. TradingView getting slow in those kind of actions. It is up now 70 ticks. Crazy. Going in and out, guys. In and out. This was an expected trade decision, but somehow the market is skyrocketing. Strange. All right, we are now in 100% winning rate with $255. More to come here, guys. More to come here. Oh boy. We have here an inversion. So if you look at the screener, we can see that all indices are now strong bullish and the dollar is strong bearish, of course. We have this fair value gap and we have this inversion. Let's see if it rises or rejects here. Did you guys took any trades? We have fair value gap and inversion. Let's see if it holds here. I can't imagine that if the Fed just came out and say we are just decreasing the rates. No. No, unfortunately the live is a bit delayed, so I was there. Oh. My connection is actually really good. It's a 1 gigabit. Maximum delay should be like 3 to 4 seconds. This is looking juicy to me, to be honest, for short. If we get a rejection, let's see. Zoro currently, I think we are like in a 50-50%, but more like looking for shorts. No confirmation yet, so it's too early to say something. But this fair value gap showing a resistance here. See, we have two scenarios here. Oh, let's see. It's moving down. We have 13 minutes until the Powell starts speaking. I think that's why market moving so slow. We should have been trusted to the analyze that we make. Look at this, it's dropping. It's like 40 ticks from now. S&P 500 just make an all-time high. What the? Wow, it really made an all-time high. So the Fed rates are unchanged and we're waiting for Powell to show up in the stage so we can, take a position, but the target is still here. Target is still here. So just like I showed in the morning live session, so there was a sell signal, there was an inversion, there was a bearish fair value gap, and there was a perfect signal, right? So if you put your stop loss somewhere here and you target this low, look at this, 1 to 3.5. What a life. Very, very nice. Okay. I watch in the Bloomberg, or you can watch from the CNBC. Both of them will give in the live. I think you can also find in YouTube. Maybe. Not sure, but there will be delay, but on the TV it will be better. So far $255. Oh, funny Oleg, welcome to live session, friend. Miss you too. Actually, I did a couple of live sessions, but I think you missed that. Uh, I did once a week, I believe. But 1 week I was away, you are right. But we back. Today, this is our second live session. We back very strong here. All right, market is still looking bearish to me now, but it is more about now a fundamentals. It's more about like a news based rather than it's a technical or whether it's a fair value gap. So we shouldn't kept our position long until the Powell speaks, right? I think today we will capture a very nice trade since we deserved it. Why? Because we are waiting patiently for a nice and juicy profit here. Oh, you working out from your country? Ah, all right. It's okay, no problem. Hope you capture some nice profits without me, huh? Market does the same thing over and over again. Look at this. It's taken out this high and it gave us an inversion and the bearish fair value gap and it filled the targets. Easy. Easy peasy. Did you got the big up move? I couldn't capture the whole move, but we captured some of it, like 13 points. Not bad, not complaining, but we could do it better, of course. But since it's a news based move, it's kind of stressful. I think how much we left? We need $1,000 to finish this account up here. Oi. Oh, you almost blow your account, my friend. It's good that you're recovering. You recovered very fast. It's like a $1,600 profit. Very nice. How much contracts you play with it? We have a bearish fair value gap here, showing a support here. Look at this. Zoro, yeah, this is a 1 minute time frame. This is a 1 minute time frame. Oh, it's happened in 2 weeks. Oh my gosh, I thought you did it in one just today. Oh, that must be painful. You know what I do is I grab another account. I just let it go. That kind of if things happen. So it's like a headache to me. All right, we have 2 minutes. Oh, so sorry for you. We will recover now. No worries, it's okay. We're getting a 3 classified buy here. Everything is now strong bullish. The market is definitely gone wild now. Let me just bottom. Okay, I don't want to see. Okay, come on. I think it is way better. The margins now are crazy. Look at the moves here. This is now becoming an inversion. Awaiting Powell's press conference now. All right. Just in time it started. Okay.
Considerable progress toward our dual mandate objectives. Inflation has eased substantially while the labor market has remained strong. And that is very good news. But inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation. As labor market tightness has eased,
Growth in the fourth quarter of last year came in at 3.2% for 2000%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have weighed on business fixed investment. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2% over the next 2 years. Participants generally revised up their growth projections since December, reflecting the strength of incoming data, including data on labor supply. The labor market remains relatively tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 265,000 jobs per month. The unemployment rate has edged up but remains low at 3.9%. Strong job creation has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue,
Not good.
easing upward pressure on inflation. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.1% at the end of next year. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as from measures from financial markets. The median projection in the SEP for total PCE inflation falls to 2.4% this year, 2.2% next year, and 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that
Order
high
filled.
inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are coming into better balance. We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same
Order
time,
filled.
reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably down toward 2%. Of course, we're committed to both sides of our dual mandate, and an unexpected weakening in the labor market could also warrant a policy response. We will continue to make our decisions meeting by meeting. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of this year, 3.9% at the end of 2025, and 3.1% at the end of 2026, still above the median longer-term funds rate. These projections
Order
are not
filled.
a committee decision or plan. If the economy does not evolve as projected, the path for policy
Order
will
filled.
adjust as appropriate to foster our maximum employment and price stability goals. Turning to our balance sheet, our securities holdings have declined by nearly $1.5 trillion since the committee began reducing our portfolio. At this meeting, we discussed issues related to slowing the pace of decline in our securities holdings. While we did not make any decisions today on this, the general sense of the committee is that it will be appropriate to slow the pace of runoff fairly soon, consistent with the plans we previously issued. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach that ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping our longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and price stability over the long term. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Microphone, right. Steve Leisman, CNBC. Mr. Chairman, the projections show somewhat higher core inflation. They also show somewhat stronger growth. What should we infer from this notion that on average rates were kept the same this year, but inflation is higher and growth is higher? Does it mean more tolerance for higher inflation and less of a willingness to slow the economy to achieve that target?
Well, it doesn't. No, it doesn't mean that. What it means is that we've seen incoming, as I pointed out in my opening remarks, we did mark up our growth forecast, and so have many other forecasters. So the economy is performing well. And the inflation data came in a little bit higher as a separate matter, and I think that caused people to write up their inflation. But nonetheless, we continue to make good progress on bringing inflation down. And so.
When you, just to follow up, when you say that you're willing to either maintain the rate for longer, what is the tolerance of the Federal Reserve for inflation coming in above its 2% target?
So we're strongly committed to bringing inflation down to 2% over time. That is our goal, and we will achieve that goal. Markets believe we will achieve that goal, and they should believe that, because that's what will happen over time. But we stress over time, and so I think we're making projections that do show that happening, and we're committed to that outcome, and we will bring it about.
Rachel. Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You and others have been saying that relief on housing inflation is coming, but it still hasn't shown up meaningfully in the CPI or the PCE. Does that challenge your assumption about when the shift will finally break through, since it hasn't at that point?
So I think there's some confidence that the market rents, lower market rent increases that we're seeing will show up in measures of housing services inflation over time. There's a little bit of uncertainty about when that will happen, but there's real confidence that they will show up eventually over time. But again, uncertainty about the exact timing of that.
Okay. And will you be able to get overall inflation down to target if housing doesn't break through quickly, and does that affect the timing for eventual cuts this year?
We will get aggregate inflation down to 2% over time. We will. And I would assume that what we'll continue to see is we'll see goods prices coming into a new equilibrium where they're going down perhaps not as quickly as they had been earlier this year, where housing services inflation will come back down as current market rents are suggesting will happen, and where non-housing services will move back down. Some combination of those three things, and it may be different from the combination we had before the pandemic, will be achieved and will bring inflation back down to 2% sustainably.
Nick Timmeros of the Wall Street Journal. Chair Powell, during your congressional testimony this month, you said that your test for making the first change to interest rates does not require you to be terribly comfortable that inflation is at 2% because interest rates are well above neutral. At the same time, you said here after the last meeting that the first cut is highly consequential. Can you reconcile these views for me? If rates are well above neutral, why would the first cut be highly consequential? Is that because you anticipate one cut would be followed by one or two more along the lines of the recalibration you made in 2019, which itself was modeled on the mid-cycle adjustment of 1995?
It's more, I would put it more in the context of what I said in my opening remarks, that the risks are really two-sided here. We're in a situation where, you know, if we ease too much or too soon, we could see inflation come back. And if we ease too late, we could do unnecessary harm to employment and, you know, people's working lives. And so, you know, we do see the risks as two-sided. So it is consequential. We want to be careful. And fortunately, with the economy growing, with the labor market strong, and with inflation coming down, we can approach that question carefully and let the data speak on that. That's really what I was thinking.
How much of that inflation that we've seen so far this year do you chalk up to one-off calendar adjustment effects following a period of high inflation versus some change in the trend we saw in the second half of last year?
So I want to start by saying I always try to be careful about dismissing data that we don't like. So you need to check yourself on that, and I'll do that. But I would say the January number, which was very high, the January CPI and PCE numbers were quite high. There's reason to think that there could be seasonal effects there. But nonetheless, we don't want to be completely dismissive of it. The February number was higher than expectations, but we have it at currently well below 30 basis points core PCE, which is not terribly high. So it's not like the January number. But I take the two of them together, and
Okay, that's enough. Just cleared out these highs. $430 is the next target.
Order filled. Order filled.
400 from the last trade here. I think like the personally I prefer trade on the non-FOMC days, but this is what it is. Are we going to make a new all-time high here? Okay, now we wait. Now we wait. We can see a rejection from here. Let's see. S&P 500 just crashed the 5,200 for the first time. A new record. Okay, still holding this fair value gap. This idea still needs a confirmation, guys. Don't took the trade yet. This Q&A is never.
I think they, but again, you don't want to, you got to be careful about dismissing the parts of the data that you don't like, so. Then February wasn't as high, but it was higher. So the question is, what are we going to see? You know, we tend to see a little bit stronger, this is in the data, a little bit stronger inflation in the first half of the year, a little bit less strong later in the year. We're going to let the data show. I don't think we really know whether this is a bump on the road or something more. We'll have to find out. In the meantime, the economy is strong, the labor market is strong, inflation has come way down, and that gives us the ability to approach this question carefully and you know, feel more confident that inflation is moving down sustainably at 2% when we take that step to begin dialing back our restrictive policy.
Well, you've talked about the desire to have confidence that inflation is continually moving down. Has the recent numbers we've gotten for inflation data dented that confidence at all?
It certainly hasn't improved our confidence. It hasn't raised anyone's confidence, but I would say that the story is really essentially the same, and that is of inflation coming down gradually toward 2% on a sometimes bumpy path, as I mentioned. I think that's what you still see. We've got 9 months of 2.5% inflation now. We've had 2 months of kind of bumpy inflation. We were saying that it's going to be a bumpy ride. We consistently said that. Now here are some bumps, and the question is, are they more than bumps? And we can't know that.
All we need is
that's
one
why we
trade
are
here.
approaching this question carefully. It is very important for everyone that we serve that we do get inflation sustainably down. And I think the historical record, you know, every situation is different, but the historical record is that you need to approach that question carefully and try to get it right the first time and not have to come back and raise rates again, perhaps, if you cut inappropriately, prematurely.
Go to Edward.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, you received a letter from, the Federal Reserve, first independent body, understanding Congress has oversight over that. You received a letter from Senators Elizabeth Warren and Sheldon Whitehouse that said, calling on you to lower interest rates, to cut interest rates, because it says, quote, the potential that it may remain too high for too long has halted advances in deploying renewable energy technologies and delayed significant climate and economic benefits from these projects. So has higher interest rates caused that?
Have they? Well, first of all, I respect our, you know, in our system of government, it is Congress that has oversight responsibility over the Fed. We place a tremendous amount of importance on our engagements with Congress and always treat them with great respect. In this case, I would say those are, you know, our mandate is for maximum employment and price stability and the other things that we do.
Welcome to
and
live
that's what we're
session,
trying to
Mazal.
accomplish. We're trying to do that in a way that sustains the strong growth we're seeing, the strong
This-
labor market we're seeing, but allows us to make
This
further
idea is
progress with
still
inflation.
valid and
That's
just
how we
waiting
can best
for a
serve the
confirmation
public
here.
and leave the other issues, which in many cases are incredibly important, such as those you mentioned, leave those to the people who have responsibility for those.
There was another letter from 24 lawmakers saying that the higher rates are squeezing the working people. How do these letters affect what you guys are doing policy-wise?
We receive these letters with respect, and we write careful responses and address concerns. We listen, again, because we're talking to the people who, in our system of government, have oversight over our activity.
Much questions.
So that's, but at the end of the day, we take that on board, but we have to make our judgments, and we have to stick to our knitting, which is maximum employment, price stability, supervise and regulate the banks, work on the payment system, the things that we do.
Claire.
Thank you. Claire Jones, Financial Times. Thanks a lot for the opportunity to ask a question.
Wanna take a short here. We have this small fair value gaps thing here. Okay. And the target will be juicy if we get in. Let's see if it respects this small fair value gap here. He is still speaking. It's a risky position, but let's see. Come on, don't want to see this candle closing up above this. Still shows respect. Not something that we want here. The wicks goes above it, the body close below it. Oh boy. This patience is killing me now. It's well respecting it, this very small tiny fair value gap here. We shall be looking for shorts, friend. We are looking for shorts. It's painful. I hate to wait that long. How many minutes took? Like wait like from 15 minutes now to just push the button. This is Nasdaq futures, and I think the short idea is getting destroyed now. Let's see. This is crazy. I think market not interested with the shorts here now. It's 8 seconds left till the bar close. Yeah, make a new high. So whatever you wanna call it, the patience pay, right? So if you click the button here in this 15 minute, we got stopped out and lose money, but now we waited patiently and didn't take a position. But it's, you know, crazy boring thing. Okay, I don't know, the target is in the upside we have this 18,500, so 40 ticks from now on, and market is now up 1%, still going up. One last time. If you see a rejection again, so we took 3 trades, 2 of win, 1 is loss, obviously. The average winning time is 16 seconds. What the? I think we'll finish the live session here, guys. We'll keep you updated in the community section, since the Powell is still speaking and I don't see any setup here. I waited so long, and you know, a little bit. Just book a profit in Euro USD. Very well done. Congratulations. So we have a bullish fair value gap. What I think is taking a long after I see rejection from this fair value gap. If that happens, I don't know. I will take a look at it and we'll target like 1 to 2. So that's my plan. We'll update you guys on the community section. Oh, that was a nice live session. We took 2 win, 1 loss. Thank you guys for joining today. That was the second live session, and we'll catch you in the next one. Keep your notification bell open so you don't miss any of live session from me. And